Thank you to the panelists. Let me focus on deposit swaps because we know that any person or business with more than 250,000 has the option to open accounts at multiple banks, correct? And then they have the ability to have that covered by FDIC. But banks can easily move deposits above the 250,000 to a 1 million maximum to other accounts through deposit swaps as well, and use companies like IntraFi Network, correct? And so let me start there because, and maybe Ms. DeVito, let me start with you here because if Silicon Valley Bank, Signature Bank, First Republic had made use of deposit sweep companies or other options to move the big bank accounts from their largest customers to other banks, the run may not have occurred. And so I guess maybe for the whole panelists, and Mr. Frazier, would love you to weigh in, what's the role here? And at what point in time is the bank responsible for also looking at this issue and addressing it? And let me just ask, with your banking experience, Mr. Frazier, what is the role for cash dispersal and sweep accounts options? Should we be looking at this more so and relying on that private sector to engage in this and more responsibility on the banks for doing these swaps? So maybe, Ms. DeVito, let's start with you and then Mr. Frazier.
Yeah, thank you, Senator. So I would just point out, and I look forward to Mr. Frazier's answer, but that sort of indicates that there are a category of depositors, particularly sophisticated ones, who are able to access more coverage than is in statute. And so to the extent that deposit insurance serves two purposes, financial stability, but also protecting individual and small dollar depositors, it has created sort of a tiered system that I think we should look to reforms to, I think, clarify across the board so that everybody is eligible for the same degree of coverage.
Okay.
Yes, Senator. So to the extent that it could be in part a private sector solution, it is today. So banks use it. My banks use that facility, but it's usually initiated by a customer request or a customer preference to have broader coverage.
So the responsibility, or at least the banks, leave it to the customers to make that decision, and they don't.
Not all.
Yeah. Okay.
So our treasury management officers would sit down with a customer and let them know about those options.
Okay.
We price them the same. We don't charge them more or less for that. That's part of our consumer protection responsibility. But it is something over time that it could be part of the deposit insurance reform or deposit insurance solution. There's merit to the idea more broadly. I'm not sure, though, to the first part of your question, though, Senator, that given the scope of what happened at the run last March, if an InterFi or an entity like that could have absorbed that kind of shock to the system, the intensity of it. And it underscores the fact that banks, if a bank has a high amount of uninsured deposits, and in our case, ours is minimal, but if it does, it is part of its liquidity planning and interest rate risk management practices, that has to be front and center. And running a bank sometimes is kind of like flying a 747 plane. You have 600 dials you're looking at every day. Liquidity is one of the most important dials. It's like your airspeed. And to lose sight of that from a risk management practice would be unheard of in almost every bank in this country. So liquidity planning is really an important part of that, and an InterFi or something like that can help in that.
Okay, I appreciate that. Let me jump on another thing that you actually talked about in your opening remarks, and this is what I think is a challenge for all of us, and you touch on it. And actually, two items you talk about are there's more shadow banks than we've seen before. Recent estimates suggest 43% of new checking and banking payment accounts this year have been opened by such non-bank entities. And then you also highlight the fact that large private credit firms are now raising money from retail investors to lend to business as well. And I guess my question to you is as we are looking at this from a regulator's perspective, how is it that we would then really look at the kind of the shadow banking system? What should we be considering as well, if anything, that we can be done?
Well, shadow banks, not being critical of a shadow bank
right,
or a fintech
correct.
at all. They do play a role, and they do foster innovation, and they do help all of us raise our technology game. So that's important, and they provide good services to customers. The consequence, though, is they're not part of the, let's call it the banking cycle, the banking system, where they take in a deposit backed by capital and invest it in a loan or an asset returning a benefit directly to the community. So what's happened is we've chunked it up into different little segments. This fintech does this fintech does that. But the consequence of it over time is it's outside of the primary regulators, and it's outside of many of the consumer laws that are in place and many of the safety and soundness expectations that banks have. That's not to suggest that they're acting recklessly. It's just suggesting the fact that they're outside of the traditional regulatory perimeter in which all of us exist.
And I appreciate that. And I know my time is up, but let me just say, if we are looking at one theme for all of this is consumer protection and financial stability, that should apply to banks and non-banks together. Wouldn't you agree?
I agree with the general statement, but more specifically to the non-banks, how then is a non-bank well capitalized to absorb a loss or to be held directly accountable for its behavior? And that's not, again, it's not to say that they're not. It's just the fallback, the safety net isn't quite as deep in terms of consumer protection, perhaps, and in terms of enforcement and the ability to supervise those entities.
Thank you. Thank you, Mr. Chairman.
Senator Cortez.